Another bank is starting to take on losses, and this one today is the Banc of California. It just announced a surprise $251 million loss, and I think pretty soon we're going to see bondholders start taking massive losses as well. This is a Los Angeles-based lender that repositioned securities into higher yielding products. It also launched the sale of $827 million in real estate and multifamily loans and retired $385 million in debt. This loss comes at the confluence of three moves the bank defended as better for its long-term health, but I think this is just a canary in the coal mine. The bank initiated the sale of $827 million in commercial real estate and multifamily construction loans. That maneuver was meant to reduce its selected credit exposure and lower the potential for future credit-related earnings volatility, right? That's from Banc of California. That's what they said. But if you think about it, if they're trying to walk away from volatility and they're selling those products, that means they're going to be marked down quite significantly, which means they're going to have to take these losses on their books, right? Which looks like that's what happened. Well, transactions of loans transferred to held for sale during the second quarter. Those should close in the third, and the bank said buyers were not going to be disclosed. Banc of California also retired $385 million in subordinated debt ahead of a significantly higher interest rate reset. This is, again, a quote from the company. The bank also, now let me stop and think. We got to think rationally. This debt is being repriced as it gets older and older and the interest rates go up. And these banks know that a lot of this debt cannot be serviced. So as this bank's taking losses on debt that it had put out, the same thing is going to collapse as these, because the bank's seeing it, and this isn't good, right? They're like, we're getting rid of this debt. They're taking losses, but it's the CMBS, these securities, that are also going to be taking losses, regardless if it's through Banc of California or another bank. That's why they're not wanting you to know which banks bought this debt, because they're going to have trouble pretty soon, depending on how much they paid for that debt, because the people that are running these projects, they're not going to be able to service the higher cost of this debt when you look at rent freezes happening in certain parts of the nation and the consumer is tapped anyway. So by raising rates or rents, they're going to have a hard time collecting. Now, the Banc of California also transferred $2.3 billion in its held to maturity securities to available for sale. So you're seeing red flags all over with this bank trying to liquidate as much as it can before the stuff hits the fan. The securities that they sold originally yielded around 2.11%, which means if they sold those, they're taking a absolutely massive haircut on the value of that debt. But Banc of California is reinvesting, they say, the proceeds on them to buy shorter duration securities at 4.87% yield. But I don't think that investors are going to think that that's so rosy. You see, this repositioning generated a 276 basis point yield pickup on redeployed balances, but created a $256 million pre-tax loss on securities, the bank said. Now, this move, they go on to say, also improved the risk-weighted asset profile of the securities portfolio, all while maintaining capital ratios significantly above well-capitalized regulatory thresholds. And that's what they're concerned with, because if they take any more losses, they may not be well secured, let's say. And this is really important that people realize this, because this is going to get worse. Now, this specific downturn amounts to about $1 per 61 per diluted common share. But Banc of California CEO said, Jared Wolf, put his focus squarely on future potential. He said, during the second quarter, we made a strategic decision to reallocate capital towards opportunities that we believe will enhance long-term results or returns, for our shareholders. He also said these actions resulted in significant one-time charges. Let me stop there. It's not just Banc of California. All these banks are in the same exact hurt locker. Interest rates went up really fast. their balance sheet is looking really weak because these held to maturity offerings that they're holding, this debt, is going to be marked down significantly when they sell. And that's why you're seeing this now hitting the market. Hey, this bank just took massive losses. And we're not going to tell you the banks that bought it because shareholders are going to start asking questions there too. This is a big issue, and it's going to get bigger going into this fall, especially as fuel prices are not lowering. Interest rates are staying high because of fuel costs. This is going to be wild. The Real Estate Ninja is out.